In this week's fastest 4 minutes in finance, continuing to follow the evidence that the bull market may have more room to run. Hello, I'm Scott Inman. Last week, we leveraged LPL research to counter the idea that we are in an AI bubble like the dot-com bubble and subsequent burst experienced at the beginning of the 21st century. Well, the comparison is rather weak, and this week we take it a step further. There's reason to believe we are still on the path to more market growth in 2026. That may be difficult to accept because the market has already produced 3 consecutive years of double-digit returns. A fourth would not be unprecedented, but it would be rare. And the S&P 500 index has hit 16 all-time highs in 2026. But if you watch our videos long enough, you'll hear me say that the market may not make much sense day to day, but eventually it returns to the fundamentals. And the key fundamental is corporate earnings. If companies are making money, their stock tends to go up. And earnings are very good right now. Look at this earnings season dashboard provided by LPL Research. You can see as of May 8th, 447 companies in the S&P 500 had reported first quarter earnings. 84% of those companies beat their earnings estimates. And the average earnings growth is sitting at a staggering 26.8%. So when you hear the noise that we are out over our skis when it comes to stock valuations, these numbers counter that. LPL portfolio strategist George Smith writes, "One of the most important dynamics in equity markets this year has been the relationship between price and earnings. While the S&P 500 price has moved higher, earnings expectations, as measured by forward earnings per share, have increased at a faster rate. In other words, stocks are actually cheaper." Here's the chart backing that up. At the time of the chart creation, the index was up 8.3% year to date, but forward earnings per share grew 12.8%. So that means the forward PE ratio is down almost 4%, and that ratio is used to determine stock valuation. So the bigger the number, the more overbought the market becomes, and when it drops, there's more justification that stocks could move higher. Of course, nothing is guaranteed, and there will continue to be volatility around global uncertainty, inflation, and the artificial intelligence build-out that produces winners and losers. But the key takeaway here is the facts don't lie. Investors should not listen to the doomsday fearmongers and focus on a long-term investing plan that believes in the American economy. Anyone who's bet against it over the long term has lost.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.